Hi, good evening to all. Today's topic is all about capital budgeting evaluation methods. It is an important topic of management accounting. First of all, we look at the meaning of a capital budgeting. It is the long-term planning for making and financing proposed capital outlays. To find out the capital expenditure in long-term perspective, we will prepare the capital budgeting. Methods are as follows. It has two methods. First one is the traditional methods. Traditional methods are based on the principles to determine the desirability of an investment project and the basis of its useful life and expected returns. This method is used for finding the project's useful life and how much we can expect from the project. For that purpose, we can use these methods. It has two types. The first one is a payback period method, shortly called as PPP. It is the number of years required to recover the original cash outlay invested in the project. This method is used for finding out the period required to recover the original cash expenses. For that purpose, we use payback period. So, to find out a PEP, we got the formula as PEP equal to initial investments divided by constant annual cash inflow. Initial investment they invested in the project and how much annual cash inflow. If we divide the initial investments by the constant annual cash inflow, we can get PEP. Then project selection criteria. If the PEP is less than the maximum acceptable payback period, accept the project. PEP is less than the maximum acceptable payback period, that time we can accept the project. If not, we will reject the project. It is the vice versa. If the PEP is greater than the maximum acceptable payback period, that time we have to reject the project. Next is the accounting or average rate of return method, or shortly called as ARR. It is the ratio of average after tax profit divided by the average investment. ARR is actually a ratio of the average profit after paying the tax. If we divide that by the average investment, we can get ARR. So to find out ARR, we have the formula as ARR equal to average annual profit after tax divided by average investment into 100. It's the selection criteria. If ARR is higher than the minimum rate established by the management, accept the project. If the ARR is less than the minimum rate, reject the project. If ARR is higher than the minimum rate, that time we have to accept the project. If the ARR is less than the minimum rate, that time we have to reject the project. Next method is the discounted cash flow method, shortly called as DCF. This method is based on the concept that a rupee earned today is more worth than a rupee earned tomorrow. These methods take into consideration the probability and also time value of money. This method focused those areas as a probability and the time value of money. It has the three types. First one is the net present value, or else called as NPV. So NPV equal to present value of cash inflows minus present value of cash outflows. These two differences we can get in the NPV. Selection criteria: if the NPV is greater than 0, accept the project. If the NPV is less than 0, reject the project. It is the project selection criteria of NPV. Next, internal rate of return or shortly called as the IRR is the discount rate that equates the NPV of an investment opportunity with rupees 0. It is the compared annual rate of return that the firm will earn if it invests in the project and receives the cash inflows. IRR is the discount rate that must be equal to the NPV. It is the annual rate of return. Every firm will earn that rate of return if it invests the projects, receives cash inflows as well. To find out IRR, we have the formula IRR equal to summation n t equal to 1 Ct divided by 1 plus r power t minus C0 equal to 0. Must be equal to 0. R denotes for internal rate of return, Ct cash inflows at a t period, Z0 equal to the initial investment. It has also selection criteria. If the IRR is greater than the cost of capital, accept the project. If the IRR is less than the cost of capital, reject the project. The selection criteria is based on the cost of capital here. Next is the profitability index method, or also called as the PI. It is a relative measure which is obtained by dividing the present of future cash inflows by the present value of the cash outlays. If we divide the present value of a cash inflow divided by initial cash outlays, we can get the profitability index. It has also the selection criteria. Accept the project when profitability index greater than 0, greater than 1. Reject the project when PI less than 1. May or may not accept when PI equal to 1. Thank you. We will see you again with another session. Until then, stay tuned, stay blessed. Bye.